Hey everyone, welcome back to Corporate Decoder. Today we're diving into the Silver Point Specialty Lending Fund's latest proxy statement, and believe me, it's more exciting than it sounds, or maybe it's exactly as exciting as it sounds. We will decode a few proposals from the fund, including changes to how much they can borrow and what they pay their investment advisor. Let's get started. The Silver Point Specialty Lending Fund has scheduled a special meeting for its shareholders on April 30, 2025. At this meeting, shareholders will vote on a few key proposals that could significantly change how the fund operates and what it costs to run it. There are three proposals for the shareholders: a change to the investment advisory agreement, an application to reduce asset coverage requirements, and changes to the declaration of trust. If the shareholders don't approve the proposals, the fund might wind up its affairs and liquidate. First up is a proposed change to the investment advisory agreement with Silver Point Specialty Credit Fund Management, LLC, the company that manages the fund's investments. Basically, they want to change how the investment advisor gets paid. The current agreement, called the Current Advisory Agreement, would be replaced with a new one called the Amended Advisory Agreement, if shareholders agree. Under the Current Advisory Agreement, the investment advisor, Silver Point Specialty Credit Fund Management LLC, is registered as an investment advisor. The advisor is a wholly owned subsidiary of Silver Point Capital LP. Edward Moulay also serves as portfolio manager of the fund and is the chief executive officer of the advisor and one of the founding principals of Silver Point Capital LP. Currently, the fund pays the advisor a management fee and an incentive fee. Both of these fees are paid by shareholders. The management fee is currently calculated at an annual rate of 0.75% of the investor's capital contributions. This fee is calculated every quarter. There are also incentive fees which are based on the fund's income and capital gains. This is calculated annually, with the advisor receiving 15% of the fund's realized capital gains after subtracting any realized capital losses and unrealized capital depreciation. So what's changing in a nutshell? They are changing the management fee and how they calculate the incentive fee. The management fee would increase from 0.75% of each shareholder's aggregate net capital contribution to 1.25% of the fund's net assets. The incentive fee for both the income incentive compensation and the capital gain 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 incentive compensation on the capital gain incentive compensation and 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 the capital gain incentive compensation will be reduced from 7% to 6%. Basically, the management fee will go up, but the performance fees will go down. It looks like the advisor has also agreed to waive APE and TENC incentive compensation will be reduced from 7% to 6%. Basically, the management fee will go up, but the performance fees will go down. It looks like the advisor has also agreed to waive 0.25% to The proposed changes mean that the advisor could potentially make more money under the new agreement, despite the incentive fee being reduced. This is because the management fee calculation is changing and the hurdle rate for incentive compensation is being lowered. Let's look at the numbers. Here is a table that compares what the fund paid for advisory fees with what they would have paid if the new agreement had been in place. For the 9 months ended September 30th, 2024, annualized the existing agreement, the management fees were $4,118,680 under the amended agreement. They would have been $6,880 agreement. They would have been $6,700 an added agreement. Total advisory fees would have risen from $14,446 and from $14,250 to $14 to fees would have gone down a little bit with $10,116 in total $147. Hold existing agreement compared to $9,447. The exempt $56 to $16,200 and the exempt advisory fees would have risen from $14,247 to $16. Under the existing agreement, the management fee for advisory fees would have risen from $14,206 to $16,028.04. This table compares the pro forma annual investment advisory fees under the amended advisory agreement, assuming the fund was subject to a 200% asset coverage requirement for the year compared with the 15% asset coverage requirement. The management fees would have been $6,026 under the 150% asset coverage. Total advisory fees would be $16,821 for the 19.5% and $26 under $2031 under the 200% asset coverage. Total advisory fees would be $16,819.21 for iPhone 20,020 over what the trustee incentive fees would have changed from 10,026 under the 195 and 20,026 under the 1,595 and $20,500 and 200,500 to 95 and 26,000 under 150% asset coverage. Total advisory fees would be 16,890.5 and 20,500 and 6,090.95 and 20% asset coverage. Total advisory 119.5. Besides his fees, the advisor is also entitled to the reimbursement of certain expenses incurred on behalf of the fund. The Board of Trustees thinks the new advisory agreement is a good deal for the fund and recommends shareholders vote for. After weighing all the considerations described above, the board, including all of the independent trustees, unanimously determined that the terms of the amended advisory agreement, including the fees, are fair and reasonable in relation to the services to be provided, and approved the amended advisory agreement as being in the best interests of the fund and its shareholders. The second proposal is about reducing the asset coverage ratio. This has to do with how much the fund can borrow. The fund is regulated as a business development company, or BDC, under the Investment Company Act of 1940. As a BDC, they are required to meet a minimum asset coverage ratio, which is the value of their total assets compared to their total debt. Before a change in the law in 2018, BDCs had to have an asset coverage ratio of at least 200%. That means they could only borrow $1 for every $1 of investor equity. But in 2018, the rules changed, and now BDCs can operate with a ratio of 50%, meaning they can borrow $220. NOLO in 2018, the rules changed, and now BDCs can operate with a ratio of 150%, meaning they can borrow $2 for every $1 of investor equity. But in 2018, the rules changed, and now BDCs can operate with a ratio of 15%, meaning they can borrow $2 for every $1 of investor equity. But in 2018, the rules changed, and now BDCs can... To do this, though, they need either approval from their independent trustees or shareholder approval. Basically, this proposal asks shareholders to say yes to the fund taking on more debt. If approved, the fund would become subject to an asset coverage ratio of at least 150% the day after the special meeting as adjourned. This table shows how leverage or borrowing can affect returns. The following table illustrates the effect of leverage on returns from an investment in our common shares, assuming that we employ our actual asset coverage ratio, a hypothetical asset coverage ratio of 200% and a hypothetical asset coverage ratio of 150%, each at various annual returns on our portfolio. For example, at a portfolio return of 5%, the corresponding return to the common shareholder, assuming 150% asset coverage, is 2.5%, while with the corresponding return to common shareholder, assuming actual asset coverage, the amount goes up to 4.39%. If the portfolio return is 10%, the return to common shareholder, assuming a 50% asset coverage, is 42.376%, and the corresponding return to common shareholder, assuming actual asset coverage, is 23.56%. Here's a table that shows the estimated expenses for different asset coverage scenarios. For the management fees as a percentage of net assets, the actual asset coverage, 200% coverage, and 150% coverage all come out to 0.76%. The incentive fees are different with the different levels of coverage. The actual asset coverage comes out to 1.86%, 200% is 1.99%, and 150% is 2.94%. Here is another category that changes with the different levels of coverage. The interest payments on borrowed funds are 6.55% with actual asset coverage, 7.57% with 200% asset coverage, and 150% asset coverage, and 14.20% with 150% asset coverage. Total annual expenses are 10.45% with actual asset coverage, 11.70% with 200% asset coverage, and 19.28% with 150% asset coverage. The board thinks this is also a good idea, noting that it gives the fund more flexibility and could potentially increase returns. They acknowledge the risks but believe the benefits outweigh them. The board recommends voting for this proposal as well. The third proposal is a change to the fund's declaration of trust. This is about when the terms of the fund's trustees expire. Basically, they want to change the rules so that the board has more flexibility to call an annual meeting to elect trustees. The board also recommends voting for this proposal. The filing includes a list of the beneficial owners of more than 5% of the fund's outstanding common stock. Finally, the report provides contact information for those who want to contact the board collate art. Now, what do we make of all this? Overall, Silver Point Specialty Lending Fund is asking its shareholders to approve changes that could lead to higher fees for the advisor and allow the fund to take on more debt. The board argues that these changes will ultimately benefit shareholders by increasing returns, but it's important to understand the potential risks involved. One notable risk is the potential for higher fees to the advisor, even though the incentive fee percentage is being reduced. The change in the management fee calculation could result in the advisor earning more money, especially if the fund increases its leverage. There's always a question of whether the shareholders would really benefit or just the management. On the other hand, the increased leverage could indeed lead to higher returns, but it also increases the risk of losses. It's a classic risk-reward trade-off. The numbers clearly showed that the costs associated with all options show an advantage to management rather than the shareholders. In conclusion, this proxy statement presents shareholders with some important decisions that could significantly impact the fund's future. It's crucial to weigh the potential benefits against the risks before casting your vote. Thanks for tuning in to Corporate Decoder. If you found this breakdown helpful, please like, comment, and subscribe for more insights into the world of corporate filings.